Well, I think the biggest issue facing the housing market is the shortage of supply. And that's come about for really a couple of reasons. One is, even before COVID, folks were deciding to invest their capital in other areas. So we'd seen a decline from the mid 2015, 2018 timeframe where housing new starts were down. You then had COVID, where for basically 2 years, even if you had started building a new home, oftentimes the workers couldn't get out, so that cut supply more. You've had a dramatic increase in interest rates. So that one of the things I think, particularly in home ownership, is that yes, the purchase price is important, but whether that interest rate is 2.5% or 7% on your mortgage could really vary your monthly payment by as much as 50 or 60%.
We have all kinds of other challenges on the supply chain side. So more supply for housing has been more constrained than a lot of people would like. And the demand's still high. People want to live somewhere. And frankly, in the midst of the COVID crisis, a lot of people said, I want to maybe move out of the urban core into other parts of the country. And so you've seen the demand be really high in certain areas. So, high demand, limited supply, prices go higher. And then I think the other part is the cost of money went up a lot. So interest rates were, incredibly low for a really long time. Now they're probably close to average, but it feels horrific because, 7% interest rate on a $400,000 home is like $1,500 more a month. So that really puts it out of reach for a lot of people.
A tool that the Federal Reserve Board uses to try to slow down inflation is actually to raise interest rates. Now, you can say, well, how does that work? Well, if you raise interest rates and it becomes more expensive to borrow, it becomes more expensive to pay your mortgage, it really acts as an overall drag on the economy.
The interest rate really is something that hits people pretty hard, because when you're looking at servicing that interest without even paying down the principal on a $200,000 home, you don't put a whole lot down, you're looking at spending almost $1,500 a month, and that never truly builds equity except to the extent the house appreciates.
Imagine we've still got a storm. The storm is inflation, and the storm is how we fly through that inflation and those cost increases and land the plane by bringing inflation down, but not throwing the economy into a recession. Because if you raise interest rates too high, people are going to cut back on buying stuff, and that could throw the whole economy into a recession. And, I wish the Fed had not raised interest rates again, but it's as much an art as it is as a science. And candidly, if we look back 8 or 9 months ago and you talk to all the smart economists, they thought for sure the American economy would be in recession at this point.
The interest rate is the time value of money, which is artificially set by the central bank, and then the risk of default. So you put those two things together, and that provides a rate. And right now, mortgage rates for 30-year fixed mortgages are over 7%. So that's a really big jump. I mean, you'd have to decrease interest by like 4% to get back to where things were before COVID.
On affordable housing, we've got a couple of issues. One, the only way we build affordable housing in this country is also by having some tax advantages. So we've got, what's called LIHTC, the low income tax credit, so that if you build affordable housing, oftentimes multifamily, oftentimes, apartments or a series of condos, there will be a tax credit that will go to help finance that deal, because, you're not going to make as much money on each unit you sell as if you're building a more expensive home. So we've got to have the tax credits, and there's a variety of them. LIHTC, low income tax credit. There's something called the new market tax credit. There's the neighborhood tax credit assistance. But you need those, frankly, we need all those renewed. So that's one issue. The other issue is, for young people in particular, it's hard to accumulate enough money to make a down payment. And even if you get to that point of making a down payment, if you were looking for a house, say 4 years ago, and the interest rates were roughly 3% on a $200,000 house, and you're looking at that same house that still might be priced at 200,000, and it's now 7%. The math on the interest rates would mean you might pay, thousands of dollars more per month.
And frankly, a lot of cities that really are trying to attract developers to build affordable housing have really put energy into their planning and zoning department. I've talked to 2 communities in my congressional district that have said we staffed up and we've tried to put our planning and zoning folks in a condition where they respond same day if possible, and it's reportable to the county commissioners if they don't respond within, or the city manager if they don't respond within 24 hours. So they're trying to turn these things around, things that would take months sometimes, but normally at least a week or 2. They're trying to turn fast because the developers and the construction teams are overbooked. I mean, they're still slammed, so they could develop anywhere. And so these communities are saying, we know you can choose where you develop. We want you to develop right here.
If suddenly you're not having people accumulate that wealth and that security of owning a home, when you move from your 30s to your 40s, then the economy slows down for many years. And what we're seeing in the economy right now, not just young people, many people who are kind of locked in, is the term, to their existing home. They might want to move. They might even be able to afford to get the down payment, but because the mortgage rates have gone up so much, they just don't feel like they can take that chance. That, again, clogs up the whole economy and ends up potentially having negative ramifications across the board.
It has huge effects for the economy. Home ownership drives long-term investment, long-term planning. It creates a stable base for the school districts. Most school districts have at least a component of their funding is based on local property taxes. And when people invest and maintain the property values, that's stable for the funding mechanism for the schools and for certain other community things that are involved in, just civic life.